Hello, very good morning to all. I'm Kelvin here again. Welcome back to today's Daily Dose of Market Insights. Very good morning. Today will be Thursday, the 12th of June, 2025. So before we jump straight into the gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap of what has taken shape yesterday as well as in today's early Asia session in terms of the respective key economic data release, as well as relevant news flow that has a potential impact on the intraday price movement on those broad-based cross-asset classes that we cover on a daily basis. That means, i.e., the major US dollar pair, the major stock indices, the two key commodities market, West Texas crude oil, and as well as gold XAU/USD. So let us start with yesterday's US session in terms of the key CPI data. So yesterday, key CPI data came in not as hot as expected. So if you look at the core inflation rate that is stripping off the volatile energy and food component, on a month-on-month basis, it came in exactly 2 basis points lower than expected. So market expecting a slight uptick to 0.3%, but however, it only rose marginally to 0.1% month-on-month. And if you look at the seasonality adjusted year-on-year figure, because sometimes month-on-month can be very erratic. So if you look at the trend on the annualized year-on-year basis, the core inflation rate came in below expectation as well. Market is expecting a slight uptick to 2.9% year-on-year, but it came in at 2.8%. So that has been in line with the similar year-on-year growth rate in April. And if you look at the trend on a basis over here, so in the last 1 year, since March, April, May, it has been hovering at a constant rate of 2.8% year-on-year. So this is the core US inflation rate analyzed on a year-on-year basis, moving out those cyclical component. Okay, so what it means that over here is that despite the fact that we know that in the economists forecast, even with some research reports stating that there will be fear of inflation pass through, given that Trump's 10% base tariff is still pretty much intact for April. But overall, on the aggregate, it seems to us that companies are still unwilling to actually have that higher prices pass through, heading down towards consumer prices, despite we start to see in earnings conference call like Walmart rising up the fear that they can't able to absorb this higher cost, and very likely they will actually increase the price tag of their food products or grocery products. But that hasn't been reflected in the CPI numbers yet for the month of May. So with that, market actually rejoiced in terms of the stock market. So if you look at the stock market, initially it actually rallied upwards at the start of the US session. So for our intraday technical outlook yesterday, we do have a bullish bias. And what's interesting over here is that the Wall Street 30, which representing the Dow Jones Industrial Average, the Nasdaq 100 and the SPX all hit our first resistance level before shaping that pullback and close in the red. All right, so at the end of the yesterday US session, the market closed in the red. So all the major stock indices closed in the red, except for the Dow Jones Industrial Average almost unchanged due to some defensive stocks that are holding well, especially the healthcare. So do not forget, Dow Jones Industrial Average is only 30 component stocks, and within these 30 component stocks, the mega cap stocks traditionally have a higher weighting in Nasdaq 100, and the S&P has a lower weighting in the Dow Jones Industrial Average. So that should explain why the Dow Jones Industrial Average closed unchanged yesterday, whereas yesterday the growth related stocks, which is primarily evidence in the mega cap technology stocks, took a hit yesterday at the second half of the US session, where SPX is down by negative 0.27%, the Nasdaq is down by negative 0.37%, and the highly oriented growth focus small caps Russell 2000 component index is down by negative 0.38%. So what causes the mega cap stocks to actually lose their shine in the later part of the US session yesterday? So let me share with the heat map. So I could see a sea of red in the mega cap technology space. So with Apple, Amazon down by negative 1.9%, Amazon down negative 2%, Google down negative 0.7%, Meta, Facebook down negative 1.18%, Nvidia down negative 0.79%. The only one that is holding the fort in Microsoft, positive 0.37%. And the reason why Dow Jones managed to actually help the fort is because of this United Healthcare Group, which is the highest weighting, biggest component weightage stock in Dow Jones Industrial Average, is up by 2% yesterday. So that should explain why Dow Jones was unchanged yesterday, as you could see in my first part of my presentation over here. So the reason why the higher beta growth, mega cap growth names took a hit on the second half of the US session was due to Trump's way of implementing his trade tariffs uncertainty. So we know that earlier part of this week market has basked in optimism about that de-escalation of trade tension between US and China. So that has already been concluded yesterday, where US and China signed a preliminary deal, a preliminary understanding. Things will go back as it is on the 12th of May or 10th or 11th of May, trade deal negotiation handshake talk between both parties in Switzerland. That means China will allow the flow of rare earths back into US. But however, there was a Wall Street report stating that that flow that was agreed on London on Tuesday, China intended to actually put a time tagline on it, a time limit of this rare earth export license to allow rare earths to flow through US, only a 6-month limit potentially. So this tentative deal is that means, i.e., after 6 months is also due for renewal. That means in terms of longevity wise, this trade tension de-escalation may be only temporary, given the fact that China only allows for a 6 months limit of the ease of export license to US. So after 6 months is due for renegotiation again. And also on top of this, Trump said that he will set unilateral tariffs in 2 weeks. So unilateral tariffs is the one that the reciprocal tariff, which is the higher tier, on top of the base tariff that he hit on 10% for all US for all US trading partners. So this higher reciprocal tariff or unilateral tariff, previously there was actually a 90-day pause that where he actually allow at the end of April, and this due to expire on 9th of July. And given the fact that there is no way to hold one-to-one negotiation talks with all the country, so Trump has planned yesterday that he may start to send out unilateral tariffs in 2 weeks to all countries that has yet to manage to negotiate a deal with the US. All right, so that also kind of spooked market a fair bit as well, and causes the US major stock indices to sell off in the later part of the US session yesterday. So now moving on towards the FX market over here. So over the FX market, what we could see over here is that the dollar actually took a hit over here. So the dollar down below the 5 days of sideways performance. So yesterday, but as with the fact that the Aussie and Kiwi still remain sideways. So if you look at the 1-day rolling performance over here, okay, the Aussie and Kiwi tend to trade sideways against the dollar. all right, against the dollar. So what you could see over here is that the dollar is the weakest against the yen, the Swiss franc, the euro, and as well as the sterling pound over here. So given the fact that is number one, the dollar actually the dollar actually weakened in general in the US session yesterday was due to that weaker than not okay, rather than that CPI number from US is not came in as hot as expected. So that actually potentially increase the chances that the Fed will still cut rates in the US in 2025 rather than continue to stand pat since the start of this year. So the market has now raised the probability of close to 80% that the Fed will cut in September, but still maintaining stand pat almost 100%, 99.8% in next week meeting, 18th of June. That means next Wednesday, i.e. Singapore time will be early Thursday. All right. So market still expecting no change in the coming June meeting. So to maintain it at 4.25% to 4.55%, this is the Fed funds rate according to the CME Fed Watch 2. So if you look at from the aggregated tab over here, where the CME Fed Watch 2 is able to combine a calculation of the various expiring months of the Fed funds futures contract, the market is now assigning a high probability of 87% during the next meeting, which is in 17th of September. Over here, even the July, they expect to maintain stand pat at 4.25%. But right now, the chances has started to increase to almost 90%, I would say 87%, that the Fed will indeed move in September by enacting a 25 basis point cut to bring it down to 4% to 4.25%. And also a rather high chance in the last meeting of 2025, which is on the 10th of December, the Fed will do another cut, and it has a high odds of 93% to bring it down lower to 3.75% to 4%. So net overall, the market is still assigning the Fed will cut 2 times, not 3 times, despite the fact that the CPI is came in less hotter than expected, but they only increased the probability of these 2 potential rate cut that may come in September and December this year. All right, so that should explain to us that the US dollar sell off yesterday. All right, and it's managed to actually broke below that trading range, that sideways 5-day trading range that has taken shape since last Monday. Right, and now it's inching back downwards to retest the April low over here. So overall, the dollar weakness still remains intact. Okay, so I explained in my previous week of daily dose, whatever bounces that we see so far in the US dollar is more corrective in nature, but the medium term trajectory is more on towards the downside of the story. All right, so now moving on will be let me share with you the price movement of the West Texas crude oil. So yesterday, West Texas crude oil very interestingly rallied, so that also came in within our expectation. So still we call that West Texas crude oil, we flipped to a bullish stance this week because it broke above the range resistance of $64 per barrel. So yesterday the WTI crude, if you look at it over here, okay, rallied by 5%, right? 5%, right? Put it as 5.5%, rallied by 5% over here. So the reason of this rally is due to rising geopolitical risk premium in the Middle East, all right? In the Middle East over here. So let me share with you, yeah, over here. So oil surges because there is a rising geopolitical tension. That means, i.e., geopolitical risk premium uptick in the Middle East because of this pertaining ongoing fought between Israel and Iran, and there is a risk that Israel might strike Iran this week, and with that, US has started to order partial evacuation of Iraq embassy, because given the fact that if Iran is being hit by Israel, Iran will actually hit US and Israel so-called interest in the Middle East, which is Iraq is one of them. Okay, so that actually explained to us the push up in this oil price yesterday, and also the push up in this oil price, that means geopolitical risk premium, then together with the dollar sell off, that actually causes safe haven assets to be in demand again, especially gold. So gold, recall that we do have a bullish buyer stance, and once the upside trigger level of 3,346 has been taken out, it actually shaped that short rally. So let me share with you gold price over here. So it has been holding on steadily. Whatever losses that has been made in the start of this week managed to actually get trimmed off after the retest of that 20-day moving average. All right. So let me open up the chart of gold to actually explain to you all the movement. So what we could see now is that the weakened dollar, the rise in geopolitical risk premium due to potential Iran Israel conflict that may impacted U.S. interests in the Middle East by striking that Iraq U.S. Call it a potential embassy in Iraq. So that causes gold price to actually rose. Yes, all right. So what I could see over here is that since the start of Monday, every time the price sell off, it managed to get trimmed in the 20-day moving average by forming a long tail candle, another long tail candle on Tuesday, a sharp bullish confirmation on Wednesday, followed by a breakthrough on, as we are speaking, in today's Asia session right now. All right, so the breakthrough comes in the upside trigger level of that 3,346 level. So later I'll share with you what are the key levels to look out for when I cover the intraday technical outlook on gold. All right, so do hang on for a minute. All right, over here. So before I jump into the second segment, just to make sure that everything is good in terms of the voice and in terms of the visuality. That means just to make sure that everything is okay. Just give me a minute. Right, this should be fine. Right, so in terms of the okay, so let's carry on. So now I've covered the okay. So I've covered the this particular first segment of the daily dose. So let me move on to the second segment, which is the intraday technical outlook segment over here. So let me expand my screen so that you guys could have a better view of the charts. Right. So let us start with the FX market first. All right, over here. So let's proceed with the euro dollar. So euro dollar, we have a neutrality stance yesterday. So what you see over here is that yesterday it broke above our neutrality limit, above the 114.90 level. So with this bullish breakout of this neutrality limit, and if you look at the hourly RSI, yes, it's at the overbought level, but there is no bearish divergence. The RSI move in line with the price action. All right, so what we could see now is, given that it's in the overbought region, there could be a risk of a minor pullback over here. Right, so a minor pullback may choose to retest around the 114.90 breakout level, but I do not want to use 114.90 breakout level as my short-term pivotal support level. I push it down slightly over here. So this slightly level over here is also the former minor swing high area, or a mini range resistance from 9th of June to 11th of June, where it managed to stage that bullish breakout. And also, if you were to do that Fibo retracement of this last push up from Wednesday minor swing low all the way up to today's intraday Asia session high, that is also the golden ratio of 61.8%. Right, so using 114.40 as my short-term pivotal support level to watch out for that minor pullback. As long as this minor pullback didn't surpass below 114.40, we will flip back to a intraday trend bullish bias for the start of a new impulsive up move sequence. Next resistance level to look out for will be 115.65. Above 115.65 may see 160.60, 160.90 next. However, if we start to see a price action breakdown and the hourly close below 114.40, so that would invalidate today's intraday trend bullish bias to see another round of choppy corrective decline movement to revisit the rising 20-day moving average that is acting as the 20-day acting as the next near-term support level at 113.60. All right, only a breakdown below 113.60 may trigger off a deeper minor corrective pullback to revisit 113 figure slash 112.70, which confluence with the rising 50-day moving average, and as well as this minor ascending channel that is in place since 12th of May. So i.e. in a nutshell, yes, we see a bullish breakout above the upper limit of the neutrality range at 114.90, but given that the RSI is at the overbought level but no bearish divergence, there could be a minor pullback taking shape during the European session. Minor pullback support level to watch out: 114.90, maximum 114.40, which is our short-term pivotal support level to maintain our intraday trend bullish bias for today on the euro dollar. Next up will be the sterling dollar. So sterling dollar, yesterday we do have a bearish bias looking for it to extend downwards to the lower limit of this bullish flag formation at the 134.15 slash 134 figure level, but prices managed to hold at the 20-day moving average, which is at this 134.70 134.50 level, and stage a bullish breakout above this bullish flag formation. So what we could have is that we got to respect the price action right now. So given the fact that it has already staged this bullish breakout from this bullish flag formation, we could no longer be bearish anymore, and we got to flip the honors back to a bullish buyer stand, indicating that minor corrective decline from last Thursday all the way down to this Tuesday has ended, and the sterling dollar is now looking to resume its minor impulsive up move sequence within its short and medium term uptrend phase that is still intact. Why? Because it's still continuing to hold above the 20-day and the 50-day moving average, and the 20-day moving average is still above the 50-day moving average as well. So with that, our hourly RSI is now hitting back towards the overbought level again, potentially, and also now is coming at a intermediate resistance that we highlighted yesterday at 135.90, and there's a bit of price action pullback as we are talking right now during the Asia session. So there could be a chance that a pullback may take place during the European session. So I'll be using 135.30, which is very close to this pullback line of that former bullish former resistance of that bullish flag formation. So this will be my pivotal support level to watch out for. 135.30 over here will be also a very clear congestion area previously. So 135.30 will be my short-term pivotal support level. We will flip to a intraday trend bullish bias for the sterling dollar above 135.90. May see the next intermediate resistance coming in at 136.40 before 136.90 next. However, if we start to see a price action breakdown with an hourly close below 135.30, that would invalidate today's intraday trend bullish bias and also invalidate yesterday bullish breakout, and see a choppy corrective decline sequence back again to revisit that 20-day moving average at 134.70 slash 134.50, which is the minor swing low of this Tuesday, 10th of June. So that's for sterling dollar. Up next will be the Aussie dollar. So the Aussie dollar is one of the outlier that is not showing any we call it dollar weakness. All right, whereas the euro and the sterling start to show dollar weakness. So the Aussie dollar right now came down over here, and right now it's almost hit our first support level at 64.75, right? 64.75, and so far the hourly RSI continues to trend downwards, all right, shaping a series of lower high and lower low as well. Okay, lower high, lower low. Whoops, what is it? Okay, lower high and lower low. So potentially there could be still another chance of the Aussie dollar to revisit this 64.75, this 65.55 support level that we highlighted yesterday. So what I could see is that this Aussie dollar, if we were to look at from a, okay, maybe I'll put it from a daily perspective. It's much clearer on the daily chart. Okay, so you look at the daily chart of the Aussie dollar since 24th of April, that means late April, it's been trading in this kind of complex sideways range configuration. All right, so there could be a risk that it could move back down to the middle part of that complex range configuration again, which is this 64.75, 64.55, which is all correspond to the rising 20-day moving average and slightly above the key 200-day moving average over here. All right, so no change. I'll be still using this pivotal resistance level of 65.37 / 65.45 that was rejected yesterday indeed, to have a short-term intraday bearish bias within a complex range configuration for the Aussie dollar to drift back down towards the middle part of this complex sideways range configuration, with the near-term support to watch out will be at 64.75, 64.55. However, only a bullish breakout with an hourly close above yesterday rejection level at 65.45 that would invalidate the bearish bias and flip the honors to the bulls for a bullish breakout scenario from this sideways range configuration that was in place since late April over here. So that's close about a month or so, to seek out the next resistance level coming in at 65.80 in the first step. So 65.80, if you go back over here, is that congestion area of 11 and 10 of November last year. All right, so that's for Aussie dollar. Right, still maintaining that intraday trend intraday bearish bias below 65.37, 65.45 within a complex range of configuration. Next up will be the dollar yen. All right, so dollar yen explode. Oops, the daily, the hourly chart. All right, so dollar yen drift down as expected over here, broke below the 20 and the 50-day moving average. So still recall that since Monday, we do expect this move up here as a corrective rebound rather than the start of an impulsive up move sequence, because how the price action transfers, it transfers into a bearish ascending wedge formation, indicating a lack of bullish momentum. And what we could see after that bearish breakdown of 144.40, 144.40 level yesterday, price action continues to trade downwards and now coming very close to our first support level at 143.50 that we highlighted yesterday. So given the fact that the hourly RSI also now is approaching the oversold region as well, so potentially when price action hit 143.50 during the European session today, there could be signs of a minor bounce taking shape. So as long as this minor bounce didn't surpass our breakdown level yesterday, which is a zone at 144.40 / 144.70, which is the minor swing high area of last yesterday's US session before the sell-off take shape, we will still maintain our intraday trend bearish bias for the dollar yen over here. So I will have a tightened short-term pivotal resistance from today from 145.35 that was rejected. I'll push it down slightly from 144.40 / 70, still maintaining our intraday trend bearish bias. Below 143.55 may see the dollar yen drifting down lower towards this maybe this level here. There's this minor congestion area. All right, this minor congestion area here at 143 figure level, which is also a psychological level. So this is the minor support to work out for. That after 143 minor support level, the next key near-term support level, which is much more important than 143, is 142.35, because 142.35 the bears managed to survive since 26th of May. All right, so that's close to about 2 weeks or so already. All right, so now only an hourly close and a bullish breakout above 144.70 that would invalidate today's intraday trend bearish bias on the dollar yen to see a squeeze up to revisit the 145.35 rejection level yesterday. All right, so in a nutshell, still maintaining the intraday trend bearish bias on the dollar yen aspect, except that as it's approaching the first support at 14350, with the hourly RSI coming close to oversold, there could be a risk of a rebound. Key short-term pivotal resistance to watch that rebound stalling will be at 144.40/144.70 tighten short-term pivotal resistance that we have on the dollar yen. Right, so that sum up the intraday technical outlook on the major US dollar pair. So now let us turn our focus now to the major stock indices, starting with the Hong Kong 33 representing the Hang Seng Index. So the Hang Seng Index today actually kind of a gap down over here, all right, gap down, and now attempting to actually shape that recovery again, all right, at this point in time. So with that over here, the the short-term pivotal support level still remains the same, because given that price action didn't break above the first resistance at 24,490 over here. So after yesterday's strong rally during the Asia session and throughout the US session, it just traded sideways before this minor gap down that's being seen in today's Asia session. So no change, 24,010 will be my short-term pivotal support level, still maintaining that intraday trend bullish bias. So only a breakout above 24,490 today may expose the next resistance level at 24,850. However, if price action starts to break down and have an hourly close below 24,010, today's intraday trend bullish bias will be invalidated to see another round of minor corrective pullback to expose the next near-term support level at 23,750, which is coming very close to the 20-day moving average. Below it may see a deeper slide to expose 23,440. Next up will be the Japan 225 representing the Nikkei 225. So the Nikkei 225 burst up as expected, hit our resistance level at 38,850 before coming downwards. Right. So right now it's now back towards the 200-day moving average very closely, and also yesterday's short-term pivotal support at 37,920, and the RSI also intending to actually reverse upwards up upon coming very close to the oversold region. Right. So still no change. Key level still remains the same, given the fact that it's now attempting to actually shape a bounce right above yesterday's short-term pivotal support and also right above the key 200-day moving average. So still using 37,920 as my short-term pivotal support, maintaining that intraday trend bullish bias despite that earlier sell-off that's been seen in the US session and in today's early Asia session. Next resistance level to watch, 38,460. Above 38,460 may retest 38,850. Only an hourly close below 37,920 will negate the bullish tone and see a potential extension of this ongoing minor corrective decline to revisit the next near-term support level at 37,680, which confluence with the 20-day moving average. Only a breakdown below 37,680 may see a deeper extension of this corrective decline to revisit the minor swing low of 2nd of June and 5th of June, acting as the next near-term support level at 37,270. Right. Now, let us proceed to the Germany 30, which has been underperforming since the start of this week, representing the German DAX. So yesterday, we do have a neutrality stance between 23,900 and 24,240. And what you see that yesterday is attempting to bounce off from the lower limit of the neutrality stance, but upon hitting close to the upper limit at 24,240, which is printed intraday high of 24,180, price action starts to break down below the 20-day moving average, all right, over here after the rejection of it. So what we could see is that downside momentum has now starts to creep into the Germany 30 after yesterday's bearish price movement and the move below the 20-day moving average. So it has been trading above the 20-day moving average previously since the bullish gap up of 23rd of April, and right now it's the first time that it managed to actually go below the 20-day moving average after the first rejection of it. So this represents a short short-term technical weakness on the Germany 30. So potentially signaling the start of a multi-day corrective decline sequence. We in a medium-term uptrend phase that is still intact, as price action going to hold above the 50-day moving average. So given that the hourly RSI has already hit the oversold level, so at the start of the European session, potentially there could be a bounce taking shape over here. So bounce resistance level to watch in the first step will be that former neutrality zone or lower limit turns into a pullback resistance at 23,880 now. Maximum will be the 20-day moving average, acting as a resistance at 24,025, and that will also be my pivotal resistance for today. All right, so using this pivotal resistance at 24,025 for any chance of a potential bounce that may take shape into these two levels over here. Thereafter, we will flip into a bearish bias for the Germany 30 below 23,675, exposes the minor swing low area of 12th of May, 15th of May, and as well as 23rd of May, acting as the next near-term support level at 23,380. Only a bullish breakout above 24,025 may negate the intraday trend bearish bias to revisit 24,240. Only a clear bird above 24,240 that was rejected. Very clear congestion area over here, a clear point of rejection. All right, since this Monday, that would only validate a potential impulsive recovery move back into the Germany 30. Price action got to clear above 24,240. All right, so for now, using 24,025, watch out for any signs of a potential bounce. All right, so at the time of this potential bounce didn't surpass above 24,025, pivotal resistance that we have for today, we will flip the bias to a bearish bias for the start of a potential corrective decline sequence within a medium-term uptrend phase for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average hit our second resistance at 43,085 as intended before shaping that pullback. And what I could see, this pullback now is attempting to stall so far, staging a rebound over here with a hourly doji-like candlestick followed by a white candle as we are speaking right now. And the way the pullback managed to store is also store at a key support level, which is the medium-term ascending channel support that I drew from the low of 7th of April, and as well as very close to the 200-day moving average at 42,580, which is my short-term, which my Titan short-term pivotal or adjusted short-term pivotal support that we have yesterday. So no change, still using 42,580 short-term pivotal support on the US Wall Street 30, maintaining that intraday trend bullish bias for another potential uplift to revisit 43,085. Only above 43,085 may expose the next resistance level at 43,290, which is close to the one-time Fibo extension taken from the low of 23rd of May, and graphically also this minor swing high area of 4th of March. However, if price action starts to shape a push down and a bearish close, a bearish breakdown with an hourly close below 42,580, that would invalidate today's intraday trend bullish bias to kickstart a minor corrective decline sequence, exposing the next near-term support level at 43,310, which confluence with the rising 20-day moving average. A breakdown below 43,310 may trigger off a deeper minor corrective decline sequence to expose 42,100 next. All right, so that's for the US Wall Street 30. Up next will be the SPX 500. So the SPX 500 also hit our resistance level at 6,050 before shaping that minor pullback. And the minor pullback now is trying to attempt to bounce off right exactly at this medium-term ascending channel support from the low of 24th of April. So given this positive price action right now, and also the bounce also attempting to bounce near off our pivotal support that we highlighted yesterday, so no change in terms of the level and trend bias. So we'll still maintain our intraday trend bullish bias for the SPX 500 for a potential recovery right now after that minor pullback that has taken shape during the US session yesterday, using 59.80 as my short-term pivotal resistance level, short-term pivotal support level. I repeat, using 59.80 as my short-term pivotal support level, maintain our intraday trend bullish bias. First resistance to watch for sure will be 60.40. Above 60.40 exposes 60.93, which is a confluence of the one-time Fibo extension and taken from the low of 23rd of May and taken from the low of 30th of May, and 60.93 also confluence with this congestion area of 14th of February and 21st of February this year. Only a sudden bearish breakdown and the hourly close below 59.80 will invalidate today's intraday trend bullish bias to kickstart a minor corrective decline sequence to expose the next near-term support level at 59.40, which is confluence with the rising 20-day moving average. Only a breakdown below 59.40 may see a deeper, extensive, minor corrective decline sequence unfolding, exposing the next near-term support at 58.50 next. All right. Lastly will be the Nasdaq 100. So the Nasdaq 100 also hit our first resistance as expected before shaping that pullback, and right now that pullback is attempting to also bounce off right exactly above our short-term pivotal support that we highlighted, and also the lower limit of this minor ascending channel that I drew from the low of 23rd of May. So still no change, still watching very closely the 21,640, 21,500 short-term pivotal support zone that we highlighted yesterday. We saw confluence with the rising 20-day moving average. So this support zone will still be used to maintain our short-term intraday bullish bias stance on the Nasdaq 100 for a recovery to revisit 22,050. Above 22,050 sees a test on the current all-time high area at 22,200 / 22,250. Only an hourly close below 21,500 may invalidate today's intraday trend bearish bias to kickstart a minor corrective decline sequence, exposing the next near-term support level at 21,180 / 21,015. All right, so that sum up the intraday technical outlook on the major stock indices. So let us now focus our attention to the commodities market, starting with gold XAU / USD. So gold XAU / USD managed to pierce above the upside trigger level at 33.46 that was previously rejected on this Tuesday. All right, so after two subsequent three retests yesterday, one time, two time, three time, it managed to have that a bullish breakthrough, and with that also hit our next resistance level as intended at 3,374. So given that the hourly RSI now is coming very close to the overbought region, there could be a risk of a minor pullback at around this level as we are speaking. First pullback support level to watch will be yesterday's upside trigger level, now turns into a key pullback support area at 3,346. Maximum 3,320, which confluence with the key 20-day moving average. That's much more important. Why? Because every time it hit the 20-day moving average since 9th of June, which is this Monday, price action managed to trim the intraday losses and survive. So this 20-day moving average will be a very key psychological level or sentiment level for the bulls to maintain the current bullish momentum trajectory. So do watch out these two key levels for today. 3,346 for a potential pullback, maximum 3,320. Tighten short-term pivotal support that we have for today, which is confluence with the key 20-day moving average. We will maintain our intraday trend bullish bias for gold. Next resistance level to watch after 3,374 in the first step will be 3,417, 3,435, which is the minor swing high area of 7th of May and 8th of May. Only a bearish breakdown and the hourly close below 3,320 may expose the next near-term support zone coming in at 32.97 / 32.77, which is confluence with the rising 50-day moving average. All right, next up will be the West Texas oil. So West Texas oil over here, it already hit our target, all right, as intended, which is the 67.35. And what we could see over here is that the hourly RSI already hit the overbought level, okay, kind of an extreme overbought level at 83, and now it really has exited from the overbought level, indicating for a risk of a minor pullback taking shape. All right, and also where the price actually got stopped after yesterday's strong rally is also the key 200-day moving average as well. So using 69.15 as my short-term pivotal resistance level on West Texas Oil, we will flip to a intraday trend bearish bias for a potential minor pullback to take shape over here. So pullback support level to watch will be 66.27. A breakdown below 66.27 may revisit 64.70/64.06, which confluence with the former range resistance that was in place since 23rd of April, now turns into a key near-term, short-term pullback support level. However, if price action starts to see a bullish breakout with an hourly close above 69.15, today's intraday bearish bias will be invalidated to see a squeeze up towards 76.60. Above 70.60 may see an extension towards 72.30, which is the swing high area of 1st of April and 3rd of April. All right, so that's for West Texas Oil, and also sum up the intraday technical outlook of all the major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So for today, during the European session, will be more pertaining to the UK economic affairs, which will have an impact on the sterling dollar, the sterling crosses, and the UK 100 CFD index. So it will be the monthly GDP growth rate for the month of April. That will be out at 2 p.m. Singapore time. And we do have RBA official Jacob speaking at 3:20 p.m. Singapore time, followed by an ECB official Schnabel speaking at 5 p.m. Singapore time. And as we head into the US session, two ECB officials speaking, 8 p.m. ECB Gondos, 8:20 p.m. ECB Schnabel again, and the all important if another inflation data to take note. This will be the business side of the story, the cost of doing business in US, or call it the business component causes, producer price index. All right, so producer price index will be out at 8:30 p.m. So for the core PPI rate, market is expecting at 3.1% year on year. So market will be paying very close attention to this number, because this is the business cost. If business cost continues to rise steadily, that could see a risk that businesses may not able to actually hold on to prices anymore, and may pass these prices down to consumers. And the CPI data, even though it's soft for the month of May, may start to tick up slightly in June. So something to look out for today, 8:30 p.m. Singapore time. That will impact almost all the asset classes. Okay, what is related to US inflationary trend. And throughout the US session, we rather a quiet session. So today we see a slew of ECB officials speaking. 10:15 p.m. we have another ECB official speaking, ECB Alderson. And closer to the so at the start of the Asia session tomorrow will be a rather quiet one. All right, so that sum up today's daily dose of market insights. I'm Kelvin here, signing off. So just give you a heads up that tomorrow I'll be off for a day for a medical appointment. So I'll be back again on next Monday. All right, so we shall speak again on next Monday, or 16th of June. So I wish you all a great day ahead, and as well as a restful weekend for this week. All right, this is Kelvin here, signing off, and we shall speak soon on next Monday. Thank you.